When we last spoke with Bob Prechter of Elliot Wave International, that was in late February, he advised clients to close out those short positions. Less than 2 weeks later, the market bottomed. So what does he see now? Bob Prechter is back with us from Atlanta. Bob, thanks for joining us.
Yeah, how have you been?
Oh, good. Tell us, how have you been? What is the Elliot Wave? What is it telling you right now about equity markets? As I mentioned, you were with us in February. You said everyone stand aside, close out those short positions. Turned out you probably saved people some money. What's going on right now?
Well, I've been pretty quiet the last 5 months, just letting the market do its thing. We're very happy that we got a big rally. It was the biggest since the high. We expected it to be large and swift. But the reason I'm interested again on maybe talking to people at large is that we're getting into a zone where I think the rally's aging. It's 50% move in 5 months. That's tremendous move. In fact, the S&P went from 667 all the way to over 1,000. If it were going to do 50% move again, it would have to go all the way to the all-time highs. So the best move is always at the beginning of an advance. Now, what's really interesting here is that if you remember back on the 9th of March when the market bottomed, there were only 3% bulls among traders. I think that's one of the things we talked about. Now we've got 88% bulls. That's not a screaming bell ringer, but it tells you that the majority has now decided that the market is bullish and attractive. And so that always makes me a little bit cautious.
Well, I was going to say, you always get a little bit nervous when there is such a preponderance on either one side, whether it's short or long. So take a look at some of the wave charts. Tell us, what do the waves tell us, and can you kind of walk us through the steps of how do you get to your next look at the market?
Sure. We've got a very clear 5-wave decline, and that's what helped us so much in late February, early March, from the top in 2007. From there, we've had a pretty typical shape, 2 steps up. Elliot called it an ABC pattern. Those are counter-trend moves. You can't really necessarily tell exactly where these are going to end, but we've entered our target area for the S&P of 1,000 to 1,100. We've entered our target area for the Dow Industrial Average of 9,000 to 10,000. In fact, we're right in the middle of there. And all of the excitement has come out only in the last 2 weeks about the economy is finally turning. So the economists are lining up saying, yeah, the economy has changed course. That's something we predicted back in early March. We said the economists are going to tell us the recession's over. People are going to say the stimulus package worked. And all of that kind of news is coming out now. What I find really interesting is that on the very first trading day of August, the S&P futures closed at 1,001, and they're still almost exactly the same level. So despite all this excitement, we really haven't had much further progress.
All right. So now you look at these different patterns. I mean, you looked at the 5 waves down. Now we're at that point, as you say, 88% of investors are bullish. What comes after what? A, B, C. Where does D fall in terms of where the S&P 500 goes?
Well, if my timing's wrong, I'll get a D on my report card, I suppose. That's the one I'm worrying about. But if this is truly a counter-trend move, and all of our work says this, from valuation to sentiment to Elliott wave patterns, is all saying this is a bear market rally. That was our opinion at the beginning. We can't tell you exactly where it'll end, but I think it's a good time for people to stop and think and take stock. Not literally, of course.
Well, we appreciate you using the ironic moniker. Go ahead, Bob. Go ahead. I beg your pardon.
Exactly. Anyway, I think the market is setting people up to fool them as it usually does. So sometime this month, perhaps a little bit later, this bear market rally is probably going to top out and lead to that next leg of decline. I don't think the bear market's over. I think we'll ultimately take out the March lows. So people need to get ready for that, and there may be a few more dollars of profit left, but I'm going to leave that for somebody else.
Bob Prechter, in looking at your work and in looking at the charts, one question that came to mind is duration. Is there anything that you've noticed differently when you look at the charts that are more contemporary as opposed to historical? Have we seen any kind of compression in terms of the time in which these market moves take place?
That's a good question. Some of the greatest manias of all time, you can look at the tulip mania, the South Sea bubble, the 1920s, roaring 20s, usually are very, very swiftly retraced. In this case, in my work, this one ended in the first quarter of 2000, and that bump back up into 2007 was really a false move based on collapsing dollar values, which are now being corrected, by the way. So I think the bear market has really been going on for 9 years. That's a long time. So we've kind of had a spread out topping process. I think the ultimate resolution, now that we've turned down from that extreme inflation of 2003 through 2007, is probably going to be pretty swift. So I expect this rally to be short. We went down for 17 months. That's a long time. So far, we've only rallied back for 5. So this could stretch out further in time. I think it'll decelerate as it does that. But nevertheless, I think once it gets going in wave 3 to the downside, you're going to see that very swift resolution, just like we had last September, October. So again, the best place for most investors to be is in very, very safe cash equivalents until we reach a terrific buying opportunity, which I think is coming up in the next few years.
Bob Prechter, does the magnitude of change matter? I mean, because you were mentioning how, you know, if you go back into March, what, 666 on the S&P 500, and you say, well, now we're traded over 1,000. If that were to continue, we'd be at an all-time high. Does the magnitude of that downturn and now the magnitude of the advance, does that matter in the wave theory?
Pim, magnitude is just about everything. The market is a fractal. That means you can follow these waves on a very short-term basis, which we never discuss because we only talk with each other every few months, to intermediate to long-term. And the whole reason I took the risk of writing that book, Conquer the Crash, was to say we have ended something that's very, very big, multi-decade move to the upside, dating all the way back to the 1932 Depression lows. If that's correct, the top that we've been building from 2000 to 2007 is a major, major top. It'll eventually even dwarf what happened in 1929 to early 1930. Now, I could be wrong about that, but I think so far defense has been the right game to play. Safety's been the right thing to do. Overvaluation is still with us, and until those things clear up, I think that'll be the game to play.
All right, we're going to continue the game. We've got more with Robert Prechter of Elliot Wave International. Indeed, the U.S. dollar, if you take a look from 2003 to 2007, it's lost about 1/5 of its value. We're going to find out if that gloomy picture for the dollar is still intact. This is Taking Stock on Bloomberg. Just joining us, this is Taking Stock on Bloomberg. I'm Pim Fox. We're speaking with Robert Prechter, president of Elliot Wave International. All right, Bob, let's talk about the dollar. You say it's making a major turn. Tell us about what's going on.
Okay, to me, this is one of the most exciting charts out there. I hope I don't end up eating my words on this, but I'm pretty excited about the dollar index chart right now. You see that little label that we have at the bottom right where it says 3% bulls? That's exactly what the low was in the S&P reading on March 9th, just before the S&P turned up and rallied 50%. People got so negative on the dollar during this summer that we had at least a dozen very famous people come out and call for hyperinflation, and most people are in that camp. They think we're going to have runaway inflation. They really think the dollar is the worst investment on the books out there. The foreign currencies were up to between 95 and 98% bulls there. So I put out an issue on the 5th of August, and I said, this looks like a completed wave pattern for the dollar. So far, that's been the bottom day. I think we're testing it in a wave 2. This could lead to a year or 2 even on the upside for the dollar. So when people say, is Bob bullish on anything, I am on this.
What makes you bullish, though? I mean, if you step back, I understand we're taking a look at specific charts and wave patterns, but, I mean, can you make a kind of external case for the U.S. dollar? I mean, why would anyone want to be buying a currency where you've got such a huge amount of debt and seemingly no way to control it?
I do think the fundamentals support it, and the reason is that the dollar is the most inflated currency on the face of the earth. That means there have been more IOUs written in dollar terms than anything else. And those are the items that have been imploding in this deflationary environment, where debtors are having trouble paying the interest. Ultimately, they'll have trouble paying the principal. I think a lot of these IOU dollar-denominated bonds, bills, notes, and so on are going to end up in default. And when those dollars disappear, the remaining dollars are going to gain in value. So we talked earlier about the possibility of the stock market, topping out and eventually having a leg down. That fits this idea of the dollar turning up. And I'd love to cover a little bit of that history for a moment, because I think it's interesting.
Please do. Go ahead, Bob.
All right. Let's take a look at the bottom left of this particular chart. This is when the dollar was making its lows back in March 2008. Remember what happened in March 2008? That is when the precious metals topped out. That was their peak price. Now look at the test of the dollar bottom there, where we have a little wave 2 mark. That was July 2008. And if you remember what happened there, oil was peaking out at $147.50 a barrel. So that's when the dollar was weak. As soon as the dollar turned strong and was soaring late last year, that's when all the investment markets were collapsing. Commodities were coming down. Oil crashed 78%. The stock market had the worst part of its decline. Okay, now look at that top where we have 93% bulls in the dollar. That happens to have been the exact low in the S&P, which was the exact high in the dollar index. So these things are powerfully contracyclical. Now, when we count a very clear, what I think is a clear, 5-wave decline from March of this year until now, or until early August, that tells me that those other investment markets, if this is correct, will start going down, or at least have some headwinds as they're trying to go up, as this dollar begins to go up. So if these markets remain contracyclical, we're going to have a bullish dollar and bearish just about everything else.
Bob, just one quick question. I mean, if you take a look at the $147 a barrel for oil, could we have to get there again in order for everyone to really kind of appreciate the value of the dollar?
I think these prices are going to go lower, not higher. So I think what we had up there was an all-time high that we were not going to see again in our lifetimes. Then oil collapsed down to 33.5, I believe was the low, dollars per barrel, and it doubled from there. It's up in the 70s now, and this is partly because the dollar has been weak, as we've seen ever since last March. So we'd have 5 months of a declining dollar and 5 months where the stock market and commodities have been rallying. And what I'm saying is both of these trends are likely to reverse.
All right. I want to thank you, Robert Prechter, Elliot Wave International. More